Hello and welcome to the Reliable Accountants Educational Series. In today's video, we'll guide you through the rules for determining your Australian tax residency status. If you're planning a move to Australia or even heading overseas, there's something you really need to get your head around: your tax residency status. Trust me, it's more important than most people think, because it decides how much tax you pay and what income you need to declare. So, let's break it all down together using the ATO's own rules. Simple, step-by-step with real-life examples. Ready? Let's go! First up, why does tax residency matter? Being an Australian tax resident isn't the same as holding a permanent residency visa or citizenship. It's about whether you're living in Australia for tax purposes. That status affects three things: what income you declare, whether you're taxed on everything you earn worldwide or just what you earn in Australia, and which tax deductions or offsets you can claim. Now, how do you know if you're a tax resident? The ATO uses 4 tests. Pass just one and you're in. Let's take a look at each. Number 1, the resides test. This is the main one. If you genuinely live in Australia as part of your daily routine, like you've got a place to stay, a job, your favorite takeaway, you're likely a tax resident. Take Priya, for example. She moves from India to Sydney, signs a lease, gets a job, and gets comfy. She's a tax resident from the day she lands, even if her visa says otherwise. Second, the domicile test. If Australia is your permanent home, you're a resident unless you're living permanently somewhere else. Like James, an Aussie who takes a 2-year contract in Dubai but keeps his house and family in Melbourne. He may be overseas, but his life's still here, so he's an Aussie tax resident. Third, the 183-day test. If you're in Australia for more than 183 days in a financial year, you might be a resident. Unless your real home is elsewhere and you're not planning to settle. Amir, visiting from the UK for 7 months, doesn't rent a place, doesn't open an Aussie bank account, and keeps popping back home. He might not be a resident under this rule, but don't forget, the other tests still count. And finally, if you're an Aussie government employee working overseas and a member of certain superannuation schemes, you're always an Australian tax resident. Simple. So, when do you officially become a resident? It's usually from the day you actually start living in Australia, not the day your visa gets the tick. Fatima, for instance, gets her PR in January but lands in March. Her tax residency starts when she steps off the plane in March. Now, what's the difference between a resident and a non-resident for tax? Residents must declare all income, worldwide. They get the tax-free threshold and can access some offsets in Medicare. Non-residents? Only income from Australia, no tax-free threshold, and bad luck? Higher tax rates. Thinking of heading overseas for good? If you cut your Aussie ties, sell your house, close your accounts, move your family, you'll likely become a non-resident from the day you leave, just like Elena, who started a new chapter in Singapore. Not sure where you fit? It's always smart to check with a registered tax agent. Reliable accountants can assist you. Better safe than sorry. No one wants a tax headache, or worse, a double tax bill. Thanks for watching. If you found this helpful, hit like and subscribe for more tax tips made simple. Need one-to-one advice? Contact Reliable Melbourne Accountants today on 1300049534 and book your consultation.